Hello, everyone. This is Calvin Russell, CEO and founder of 850 Club Credit Consultation. Hope everyone's doing well today. In this video, we're going to go over the new and improved self-employment loan. Okay, so now this is not the only option that's available, but this is one of the best options that is available. Okay, depending on your tax situation. So let's go ahead and break that down. So if you are looking to purchase property and you are self-employed, the easiest way to go is it going to be, the traditional way, okay, where you get either an FHA, FHA 203K, conventional. No matter your choice between those particular options, you will be able to make something happen depending on your tax situation. Okay, so now what does that mean? So traditionally, when you are looking to get a home, you have to give W-2s, tax returns, things of that sort. Now, if you're self-employed, it's the same thing. They're going to be looking for tax returns as well. But sometimes when the people are self-employed, sometimes their deductions are substantially higher to avoid paying taxes. Now, this is very common, okay? I'm not giving you guys tax advice, okay? But this usually ends up leading to a lower buying power or a denial altogether because the amount of income that's being shown to the IRS is simply not enough to qualify, either for a pre-approval in general, or you may not be able to qualify for a loan, in the particular area that you're trying to purchase in. So now with this new and improved option, this is where you can put 10% down, and they don't look at your tax returns. They look at your bank statements, okay? Now, you got to make sure you have your bank statements in order. If you want to go 3 months, you can give them the 3 months, you can give them the 6 months. Lenders are going to be slightly different on this, but for the most part, as long as you can provide bank statements to show proof of your income, then they will go ahead and give you an approval based on that. Since it's a riskier loan, mainly because instead of them going off of tax returns, number one, if they go off of tax returns, that shows that, number one, you've been in business for 2 years, okay? Number two, that shows that you're filing taxes, okay? Versus a brand new business. And we know how businesses are. Businesses are here today, going tomorrow. So since the risk is higher, they're going to increase the interest rate slightly, okay? And then they're going to also request 10% down instead of 3.5% down. Okay, so that's the only way to kind of go. I think that's an amazing option to purchase property. And if you're like, well, you know what, I don't have 10% down. So what do I do? Well, you have to wait until you build enough. You have to wait until time has passed to where you build up enough revenue to show that you can qualify for X amount of property. Okay. Now, again, we're not giving tax advice or anything like that at all. So it's most definitely up to you on how you do your deductions, but just do understand when you do a tremendous amount of deductions and bring your income, it's really not necessarily the deductions. It's a little bit of both, because you can have $30,000 worth of deductions, but that's 30,000 subtracted from $100,000 gross revenue. Okay, so now you're showing 70,000. So, but there is no set amount per se. It's more so not having the income be enough or high enough to get the pre-approval that you're looking for. Okay, so for example, if you're looking to be like in a 250 range, you need to show at least about $60,000 worth of income. Okay, now that's going to play a role too, because you're looking at, car notes may play a role, student loans may play a role. So the more income you show, the better, depending on how much property you're trying to buy. Now, if you're just trying to buy $100,000 property, you may be fine without waiting for like to put down 10%. You probably could do it with the way that you have your deduction set up, depending on how much you actually bring it down to. Okay, but you want to keep your income above 30,000, your net income line 31C. Okay, and that's on your schedule C, I should say, line 31. Okay, the tax document. That's what they go by, the net income. So you have to keep an eye on that. So you either have to have that number higher, but here's the catch. When you have that number higher, now there's a potential chance you're going to have a tax liability. Okay. And then, of course, if you want to purchase property, when we kind of talked about this in another video, you either have to pay the tax liability in full, or you can get on a payment plan. If you decide to get on a payment plan, that's perfectly fine, but you cannot get the pre-approval until after the third payment has been made. Okay, so again, those are your options if you're looking to go into get approved for a mortgage, get self-employed, and that's the most recent updated option is 10% down, slightly higher interest rate because there's more risk. Okay, and they're looking at 3 to 6 months bank statements instead of looking at your tax returns. So hopefully that was helpful. Of course, you guys know we also talk about credit, about home buying, property ownership, things of that sort. So hopefully, you guys like that information. If you like this video, go ahead and like it. If you want to share it, share it. And as always, be sure to subscribe as we have nothing but great content on the way. Thank you all so much. Have a great day.